the debt and your fiat losing money, which was why you were so spot on with your very first question and why I say it always comes back to that. And that's your reason why you save in gold ounces. And you will pivot some of that into silver and into miners. So
as the price of gold stays at these elevated levels and higher, the repricing in the mining sector seems to be an inevitable development. There's been some positive movement recently for some of the miners as earnings have been announced. But based on your technical analysis, what is your expectation for the miners over, say, the next 12 months?
People will get into them too soon, is my expectation. And I've made some of these mistakes myself. I've got into silver a little too soon in retrospect. So I always go back and review how I've done. I have a good amount of gold and I have a good amount of silver. And actually, the only thing I regret is that I didn't have a higher allocation of gold. Instead of, I should have been 10%. My big fear was unobtainium on silver. So I said, get it while you can. In retrospect, if you look at my last 15 years of accumulation here, gold is boss. And I'm going to give you a kind of microcosm example of that, which is also easy. And I don't know if you have any crypto bros in your audience, but actually the main mover and gain of market cap has been Bitcoin in the crypto markets. And it's the first and the original, and it's the god market of cryptos, which is a small subset of the anti-fiats. So I put gold right up there, and I'm nervous about the origins of this digital gold personally, but I will trade it. I might have a small allocation investment. I've got in gold, however, I trust because I can hold it, but they have a similar dynamic, and it was Bitcoin dominance. So if you look at the size of the pie, all the others are actually lagging and all of that. So the ETFs, all of that's come in. So the big guy moves first before the higher betas. The higher betas like silver, platinum, etc. in the metals markets will move violently, but that period can be incredibly short, actually. In fact, given the overall duration of the metal, it can be as a percentage exceedingly short. So they participate, they lag, they're frustrating. Most people get impatient and frustrated, and they move away from precious metals entirely because they go all in on silver, saying, I need to make more money than gold. Let me rather be there. And then they sit and they say, oh, I've held this for 5 years and I've hardly made anything yet. Get the gold, get slow, steady progress first. Save in gold ounces. Yes, I'm not saying get no silver, but don't maybe have 15%, 20% of your PMs in silver. There will come a point where you can swap your allocation or trade out of your allocation of gold into silver. Gold is always liquid and easy to sell. And you can rebalance to say 50-50 once our gold-silver ratio actually moves down. And we were inaccurate on the gold-silver ratio. We thought we had a major event. So if I can, I'm going to go back to the charts and just answer that a little bit. Sure. Why are we winding? And this tells us the cycle is going to be longer. In other words, we're having an extended play. We were of the opinion during this period, if you can see that orange line, when this event occurred, that we'd had a major move in the gold-silver ratio. And that we were going to be potentially following through on that to the downside to our core level that must fall. And we've had a return move that didn't just return to the orange line, but is actually going beyond. And by the time we've run this, which it's looking closer to doing, our probability meter is dropping as we're getting closer to this. If we run through what I think is going to be around the 94 ratio, then you could have a different technical take for this. Instead of this being the environment for a sell-off to the downside, you might in fact have something that closer resembles something like this. Let me redraw that again. I didn't nail it. A bit of a broadening structure like that for which we would expect a possibility of an extension to the upside of gold against silver for a while longer before eventually this occurs. So what that tells me is the cycle and the game is being extended. The print and pretend play, as it has many times. People have been calling the end of the economic system for quite a while. Their ability to extend and pretend has been vast. We can't deny that is happening. So you could see gold still be the dominant. The problem is when you damage industry, there is an industrial component with silver. It's in your solar panels. It's required for other things and usage. So you damage the demand for the metal. And I will say the metal is priced at the margin. It's priced at who needs it most and has to buy now. And if there's normally X amount going into solar panels because you and I want to be self-reliant, but now the economy's been killed and I don't have the same amount of money income coming in, so I'm postponing putting more panels on my garage and other properties to get silver. The industrial element is going down. That's a disinflationary, and the price being determined at the margin where the miners have to sell to just pay the rent checks and salary checks. That what you tend to have is that you get a weak market on account of industrial demand. And this is the problem with us. The demand equation is driven by the larger mass, not actually by the oligarchical corporations. And the oligarchical corporations like cheap silver. Ask Tesla, which has about 5, and some people say even 12 kilos, depending on vehicle of silver in them. So they're not going to complain. They're not going to campaign higher silver prices, please. So unfortunately, when you kill industrial demand, you get a down leg. In that Substack article, the last one we did, we highlighted how there was a downturn coming. USD JPY, the unwind was continuing. This was in July. We pointed this out before the crash. And we pointed out the collapse in copper prices, which is a semi-precious metal, very important for industry. So when you put, unfortunately, silver has sometimes softens more with copper than it does with gold. So your greatest defense against monetary collapse is gold, which is a pure monetary metal with very small industrial demand, usually jewelry.
I'm gonna ask you a question. I'm gonna add something into it that I wasn't intending. There's been a massive underinvestment in commodities for more than a decade. My initial question was, do you see this as a situation where the investing public will realize that commodities are too cheap to not be all in on the sector right now? But I'm going to augment the question and add in there, with the state of the economy and the Fed being late and them looking at lagging indicators. And as you said earlier, they are a lagging indicator. Do you, and with your discussion and your points on really there's not enough buyers for the treasuries, are you seeing them needing to come in, do some helicopter money, do some rescue money, monetize the debt, and that's going to be a greater impact heaping on top of the commodity sector?
So if I'm to understand the question, is commodities generally going to continue to go up broadly, and are you expecting a second wave of or another wave? It wouldn't be the second, of proliferation at the bottom of any recession that we may be in.
Okay, yeah.
Yeah, so just let me know if I'm answering your question. If I answer that, sorry, because there's quite a lot of bits in there. So when we talk about commodities, there's energy commodities, and then there's soft commodities, and then there's the kind of industrial and precious metals commodities that we've been discussing. The energies, because of the retail and the consumer and the potential for demand destruction currently going on, that I'm a little more circumspect. In fact, one of our possible trades was, you could be short oil, long gold. So you could be short the monetary substitute, which is clearly part and parcel of the debt-based collapse. And you could be short oil, which is a demand inflationary item, as you're spilling into a recession, on the basis that it's going to be pretty hard to keep oil up. If nobody's flying for business meetings anymore, there's not ordering off Amazon and delivery going on to the same scale, et cetera, et cetera. And apart from, there's the war wild card, but we've had a lot of threats of war. I think that's quite baked in. People are expecting an ongoing conflict in Ukraine, Russia. They're expecting the potential of Israel. So it's probably baked in, but it could escalate violently and you get a reaction. That could be a sort of delta hedge inside of the commodity category where you could be long those, or you just stay gold long a fiat, like the dollar or one of the others. So commodities, I want to take you to softs that are neither energy nor monetary, because they're quite interesting. And this is about inflation. Is it really, are we really winning against inflation? So here's a coffee contract. You can see we're at localized highs here, very similar to 2022 when we were hitting 9.1%, I think it was, the cusp of 2021 into 2022. And we are back up here. Now, I can see some selling across these wicks. It's not going to immediately go higher. There could, in fact, potentially be that pullback. So I'm in the demand-destroying, potential slightly disinflationary period, having a little bit of a tail, even if the stock market has that hammer and continues to grind up. And this is just a once-off slap in the face. There could still be a bit of easing here again on account of the consumer. But softs, I don't see long-term, even on a small correction, going lower again. So I see these naturally recovering in due course, then the proliferation might happen, and then going to new highs eventually in the longer, medium term, long term. Short term, I could see them coming off a tiny bit, but not too far. I don't think we take out these lows. So we've broken range here. This is the Arabica coffee bean. It's quite a big contract. Robusta is the other coffee bean that trades over here. And you can see quite clearly that these have been moving off lows. This is a major turn. This is proof of fiat proliferation. Your coffee is getting more expensive. And then I saw a video on IMF, and they were making inflation all about supply and demand. You know, either the suppliers had droughts and can't supply, or there's been an excess demand because, you know, COVID shut everything down and everyone's restocking. Neither of those hold for the two coffee beans. You know, you're getting decent crops. There's always rains. There's always droughts. But generally, we're getting consistent output out of this. So
do you expect them? Do you expect them to come out and tell us that the purchasing power of the currency is degrading?
Yes, that's no, indeed. Well, that's my point I'm essentially making. This puff piece that I was watching, and it was, you know, very soft and fuzzy, and it's all about supply and demand, and this is how it happened. And I'm like, no, you know better, and you're lying to us. The central banks have proliferated, and there's plenty beans. There's just no more cheap beans. There's plenty of oil. There's plenty of $200 oil. Trust me, if we're paying $200, there's plenty of it. But there isn't any $10 gas anymore as it was in the 70s and the 80s. That's the issue. And that's all about currency proliferation and destruction. So coffee, very big and important market, big volume market. This is showing you exactly. By the way, you want to have a look at cocoa as well. It's not an isolated event. So the truth of the matter is their lies don't stand up anymore. This is fiat destruction. Again, a bit of a blow off top, could rest a little bit. We're on a monthly chart here, but it's, you know, it's held pretty close to its highs for quite a bit now. And we are already in a bit of a risk off environment, and it seems to be holding that level of support. So you get a third move up like that, and I'll start drawing triangles and telling you, get ready for your next upside break. This is fiat proliferation. And can I say something on commodities? These should be disinflationary. They should have a slow gradient of downside. Not flat, disinflationary. We've gone from it being high manual labor to literally a family with 4, 5, 6 members running 60,000 hectares to 120,000 with combine harvesters and everything. You know, we have got really efficient at maximizing. There's all sorts of techniques. Some of them I'm not sure entirely good for us and the soil and the consumer, but we've got consistently through technology more efficient at extracting this. This should generally be a disinflationary chart when taken over the monthly. And commoditization doesn't just refer to the category, it's also used in, if, for example, when you bring out something super new and super cool, like a one-man hover plane, where it's a big drone and I can fly to work instead. What ends up happening is that's exceedingly expensive until it's an iPhone and everybody has one. Then it comes down substantially. Then it's no much more than a car by pricing, and you know, people are competing aggressively. So the commoditization of something is when it's scale manufactured super efficiently. There's no more supernormal profits in it. It's a very competitive market. It's been commoditized. My pink Crocs, the factory's been made, the manufacturing line's done, all the dye's been bought. It doesn't cost much more per unit to just leave the machine on overnight, stamping out the shoes. It literally is done. So your unit cost goes right down. Now, farming, getting bigger lands, scaling right up is at a very, very high efficiency. Hence why you should be disinflationary. So what these charts are actually showing you is the loss of buying power of the dollar.
Yeah.
Because there's two things in here. Different commodities, all of which under the same disinflationary technological forces and priced in dollar. What's the problem? There's no droughts in the cocoa lands. If you say, oh, coffee had a bad crop, what about cocoa? You have enough years that these things all flatten out. So it's quite clear they all have similar charts on the monthly time frame. So we are talking about something that is actually very tight margin business that is super efficient, having runaway surges. Whether you're looking at the Robusta or the cocoa, they're slightly different, driven by their own specific market criteria, but they're all showing the same thing. Since 2020, you've gone up on the less aggressive chart compared to the cocoa chart. You've gone from 1,000 to 4,000.
So what's amazing is that today they were celebrating that inflation's coming down, and it's going to be, you know, a impetus for the Fed to or clear the path, clear the way for the Fed to be able to do their rate cuts come September. But the charts are saying something different. They're not showing inflation coming down and disappearing. They're showing the continual loss of purchasing power, and that's only going to continue.
Correct. I mean, this is a classic macro continuation pattern that you've got here. Many people will be shouting out at your screen, I see a bull flag there, you know, a 2002 major bull market run into 2008, remember, manufactured, financially engineered, over-leveraged crash, 2008. Another one, the Shanghai Accord, 2016 into the lows of 19, when we went into CV19, hence the 19, and since then, leg up. All the coffee chart, a Robusta bean, is actually your economic cycle chart. I can point all the events out to you of what's going on here and show you a technical analysis chart that is a bull flag. And it's all about the debt and your fiat losing money, which was why you were so spot on with your very first question and why I say it always comes back to that. And that's your reason why you save in gold ounces. And you will pivot some of that into silver and into miners. So you also started a question on miners that I never fully answered. If you'll allow me, I'll make sure I
please,
have you hanging. The silver and miners comes later, the higher beta. When we get Usain is already in a canter and he's kicking those knees up and he's ready to start really flicking his spikes and kicking back those heels. That's when we go, okay, boys, this is the sexy bit. We add the miners and the silver will follow, and then the miners. The miners have a problem. During this dearth of period, they have diluted generally gold ounces per share because they've had to continue operating on terrible money. So they've got a really valuable product that they're not really being paid what they should be paid, and they dilute equity. So they're not finding new ground, they're not replacing those ounces in the ground, and they've had the inflationary forces of breaking a rock and making holes in the ground, and the energy and all of those aspects involved in mining coming up underneath them. So the inflation is a tax that comes from under up. And the taxation, the marginal tax brackets, are the ones that come from top down. And what we busy experience as consumers and even businesses, normal businesses, is the base cost coming up against you, which is the inflationary tax. And then you bracket creep, this is the marginal tax. And this is why people are getting squeezed. And this is why I say, leave your companies, have optionality, have offshore companies, look at structure, look at your tax elements, because none of that money is going after good. They'll raise debt and dilute your currency anyway. You're paying tax on the extreme high inflation anyway. So, you know, we shouldn't be moral about this. These things are all going to collapse. No good is coming of what they're taking off you, and they're not sending you a thank you letter. It actually would bring it to a close sooner, and you would stop the funding of the military industrial complex, the pharma industrial complex, many of these weaponized complex, the status surveillance finance complex of Microsoft, Facebook, Meta, and all of these people that are scooping your data. They are attack vectors. They aren't friends. Don't fund them. Who's funding them? Government is giving them contracts. Who's giving government the money? You are. You're paying for your own prisons. Stop paying for your own prisons and opt out. That's a big message, and it's an important message. Save in gold and recognize certain nations are going to have a far larger deflationary event. And the surprising thing is countries you'd never have considered before that we all look down on as third world. As someone who's lived in South Africa, Europe, England, everywhere, you know, we all have these mindsets of levels. The high-ranking nations that are service industry nations that are of the Western world are the ones that are going to undergo this massive financial repricing. And with it, they'll be distracted with major social unrest and geopolitics. You're seeing also in the UK, I mentioned this with the two-tier policing. It's not going to be good places to be. And places, even in Latin America, in the Southern Hemisphere, Southern Africa, Botswana, Namibia, even South Africa, they have their problems. There's no perfect solution. Bali, Indonesia, these are going to be better places to be for you in your financial development, for your family, and even from a security and risk point of view. And this is the solution I try help everyone to get. And it's not a nice message. When you live in the US, you've got your beautiful big roads, you're comfortable, you've got a great gym, you've got lots of friends, you went to school and university. But there is a real event coming, and inertia is sin.
Well, so this has been a fantastic conversation. I can talk to you all day. I've got about 10 more questions that I did not even get to. Before we wrap up here and I ask you, Francis, our final question, I just want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, metals, miners, artificial intelligence, and every single expert interview that we conduct. It's all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History nor Economics." This free gift, it's a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Francis as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. It's time now for our Golden Nugget segment, Francis. Let's discuss portfolio positioning. Based on all we've discussed today, and with your experience and worldview as the backdrop, how are you positioning for the next 12 months? What assets do you like, and what assets do you absolutely want to stay far away from?
Yeah, great question. If it wasn't already obvious, I'm a massive fan of saving in gold ounces. I think you want to be grossly overweight. The notion of a 5% allocation is typical allocation of years gone by in a far safer world. When it's time to be overweight, I would be substantially beyond that personally in terms of my allocations. I do have a speculative position. So if I was, let's just say for fun, I was 40% precious metals, I would say ideally I would want that to be 35% gold. If that's my my gold, my precious metals portfolio is 40%, I would ideally like it to be 35%, ready to move it to half, 20 and 20, gold, silver, and then the miners even 15, 10. This is as this process unfolds. So there's a little bit of timing and active management in it. That would be sort of 25 and then add 10% maybe in the miners as well, where you can get real multiples on it. Remember, statism and governments are your problem. And maybe the dangerous miners will be, and this is kind of counterintuitive and potentially wrong, but America and Canada could be the problematic ones. They seem to be getting the new world order communism, and the old communist areas or the rest of the world is finding capitalism. So, you know, a mine in Indonesia might actually be better than a mine in Nevada. I don't know, but I do feel that the world is changing and things are pivoting. There's a twist coming on. So that's the precious metals being quite a chunky version of that. I actually hold property that I can live in, and I aim to rent it when I'm not in it. So the concept of Airbnbs, and I like optionality. So this is kind of an element that is bit portfolio, but is also reset prepping in terms of being able to live. I'm speaking to you in Panama at the moment. I have in other BRICS and out of the West nations property investments, which I go and live in and I move around. That also helps me with my tax structures to ensure I am not funding these things. So I actually have a holistic solution that also goes into structure. So those are property holdings, but they're property holdings in places I would be more surprised if we got real draconian wealth taxes on property first. I think they'll become later. In fact, for example, one of the properties I'm in has a 30-year guarantee of no tax. So it was in a regenerative, aspirational, gentrifying area and has a contract. That's one of the key features that I like, because no matter who comes in governmentally, squeezing you out of your assets is part of the game, I feel. You've got to hang on to what you've got. Hence, bar in your hand of gold, and hence a property with a 30-year guarantee, regardless of the government of the day, with no property taxes in it, is interesting to me. How do they get you out of your fixed property? They turn the screws and turn you into a forced seller. How do they do that? Taxation. You can't leave and cross the border with it. So have optionality in resetting. So my prepper, our branding is the reset sniper, the market sniper, which is the technical analysis on traditional markets, and even the crypto sniper. I live in all those circles and in the overlap point. So I buy an asset for it, hopefully to preserve wealth, but also to serve me in some semblance where I have optionality in the global village. Because there was arbitrage when we had lockdown. Some places were worse than others. Some did mandate, some bullied people. And the West came out very poorly out of that experiment, if I can say. And next time, it might be more so. The trend is bad. The trend is down, even though from a higher up point. In other places that are lower up, that you have to put up maybe with certain things, are actually on different trends. And when you get downside, everyone will say, you're so negative, nihilistic, or things like that. Where one place something's deflating, money moves and flows like water and energy. Other things are inflating. There's real opportunity. The places of growth are not the places of decline.
So is there,
come as a surprise.
I appreciate all of that. Is there something, one or two assets that you are completely staying away from? Debt
markets. For everything I've said before. And there's people that say, oh, we're going to get rate cuts. I'm going to go I'm going to go long some calls on TLT. I go, good luck. That could turn on you in a single week and you go into rate spikes. Because suddenly, woo, what happened? The Japanese yen unwind happens. Boom, the dollar starts crashing. Boom, boom, boom. You know, there were chaos. Debt markets, forget everyone who says, tempts you with getting into the debt markets, and expect lots of temptations for it. Oh, it's such good value right now. the more they need it. The suckers will be seduced at the worst moment. Whenever something that wasn't easily available to you becomes readily available, expect you're the patsy being fed the poison that nobody else wants to hold. Debt markets, never in any circumstances in an absolute proliferation environment, buy the absolutely available everywhere and generated at ever greater. You are lining up in a queue to buy 1,000 pairs of pink Crocs.
A wonderful conversation, Francis. Thank you for coming on to the Metals and Miners podcast, for being so generous with your time, your analysis, and ideas. It's been incredible to spend the time with you. Would you please share with the viewers where they can learn more about your work and how they can connect with you?
Absolutely. I thoroughly enjoyed it. We should do a part two. I hate the fact that I haven't answered all your questions. I apologize for long form answers, but sometimes you need that color. For people that like what they saw or wish to engage and recognize that we are building solutions for a different kind of economic series of events that you have not seen and your parents didn't see. This is a multi-generational reset environment. We are seeking to build wealth and retain and protect wealth during a period where there will be major social, financial events made to coincide to create the shock and awe and chaos. If you haven't pre-planned, you will be caught out by it. And that is our primary modus operandi. We use technical analysis to see what the insiders are doing. That is how we saw the yen carry trade beginning to unwind, the copper turning down and expected a downfall, and we could reduce our long exposure and even contemplate short exposure. I have a YouTube channel called The Market Sniper. I also have the Crypto Sniper for the high beta potential, which we do on small percentages without marrying it. Marry your girlfriend, don't marry these assets. I don't trust them fully, but if they're going to go up and we can develop wealth for our people, we want to. So those two YouTube channels, X profile on the same name. Thanks for having me, and let's do a part two sometime.
Absolutely. I will put all of that information up on the screen. There'll be links in the description for everybody to click through to get over to your material, learn more about your work, what you're doing. Everybody needs to follow Francis. He shares repeatedly on X. His information is very valuable. It's detailed. It's technical. He's an educator. He's a teacher. And he's looking to share. So get connected with Francis. I look forward to having you back on, Francis. Thank you for being here with us, and everybody else, thank you for watching.
Pleasure.
I just want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, metals, miners, artificial intelligence, and every single expert interview that we conduct. It's all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History nor Economics." This free gift, it's a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us.